So we're starting with the Dynamite panel. We talk about investing in Greece. And here are the gentlemen who are investing in Greece. So they are going to share with us their experience, their story in Greece, how they look at things, and also tell us what needs to be done to make things better. And we have with us Antonios Achilleoudis, the Managing Director of AXIA, who is going to moderate the panel. Konstantinos Karides, unfortunately, from Reed Smith, got the flu, so he had to stay home. But Antonios, who was a panelist, will do a great job as moderator. He knows the topic inside out. Actually, he is the person who brought a number of those investors to Greece. So, Tony, go ahead. We have the countdown clock there.
Okay. Thank you, Nicola. Actually, thank you for such an amazing organization again. You guys pulled it off. So Nicolas and his team at Capital Link deserve a very warm congratulations. I want to thank the panelists, the esteemed panelists who are with us. All of these are investors who basically participated in one way or another in Greece and are mostly invested there as well. Just to make a quick intro, and then I'll give everybody a couple of minutes. Stephen Johnson with Wilbur Ross, John Koudounis, who is the CEO of Calamos Investment, John Wollen, who is the portfolio manager and founder of Waterwheel, Kyle Bass, who is the chief investment officer of Hayman Capital, and Theo Yatragos, who's the managing director and head of IB Central and Southeastern Europe. Stephen, let's go down the line and make a small intro into your experience in Greece and Wilbur Ross and what you guys have done in the country.
Sure. I hope this is on. Good. Hi, Steve Johnson. Really, I guess, been with my group now for 10+ years. Started doing a lot of NPL framework, renegotiating some deals that we had owned both from a private equity standpoint as well as some other assets we'd purchased over the way. Currently, we're an investor in Eurobank. I sit on the board of the bank now. I actually joined the bank the day of the referendum being announced. So I've been on a capital control bank board for the entire time in Greece. Other than that, we have about $1 billion in shipping assets too across the world. So.
Great. John?
Yes, I'm John Koudounis. I'm CEO of Calamos Investments. And I've been going to Greece for, well, all my life, but the last several years, probably the last 6, 7 years, I've been going during, with some of my other investor friends. Before I worked with John Calamos, I would go with him, I'd go with Dimitropoulos, and we would look at different investments during that course of time. About 1.5 years ago, I joined Calamos Investments, and since then we started investing in Greece. Last December was our first acquisition of a smaller insurance company, and then we tendered and won the tender for Ethniki Asfalistiki, which is a larger insurance company. So we thought the timing was right, and I think that's what this panel is about. We'll talk about why we think that is.
John?
Hi, my name is John Wollen from Waterwheel Capital Management. I've spent the last 5 or 6 years pretty deeply involved in Greece, but formerly at my former firm called Alden Global Capital. I recently spun this firm out into a new registered investment advisor, Waterwheel, which we started up on November 1st. We are focused in the public markets, so the GGBs, bank equities, and other equities. We're long short, so at different times over the last 5 years, we've been both long and short, various different securities, but focused on the public markets.
Hi, I'm Kyle Bass. My first trip to Greece was 2009, where I met the finance minister at that point in time, where he handed me an Invest in Greece fob. And it was the number of properties that they were going to auction off in the next 12 to 18 months to repay all of the outstanding sovereign obligations, and everything was going to be fine back in 2009. I saved that fob to have as a matter of record going forward. But Greece has come a long way. We invest globally. And I think Greece is the single most interesting place in the world to be allocating capital to today, given the fact that it's gone through such a difficult economic period. I see all of the signs in the macroeconomy of Greece are turning up, and it looks like this government is starting to embrace all of the things that need to be done to turn Greece around. So with that, we invest in both the public and the private markets, and have had relationships with AXIA and some friends, George, in Greece for a long time, and we're excited about the opportunity.
Good afternoon. I'm Theo Yatrakos. I'm a managing director at Citi and the only member on this panel who is not an investor, but rather facilitating and helping our clients, whether it's governments, corporates, financial institutions, and ultimately institutional investors to conduct their business. And clearly it's been an interesting ride last 5 or 6 years. I do remember that back in 2011 or 2012, some of our clients, predominantly the Greek government, entrusted us with the privilege of soliciting investor interest and raising awareness for a number of important projects, be it Hellinikon, regional airports, Astir, and so on and so forth. Clearly there is a common denominator, and probably we're going to talk about it, which is that things take time. Some of those projects which we started working on in 2011 we're actually still working on or we recently completed. But I think the other theme that probably we should be touching on is we're talking about a very different sort of conversations that we're having with prospective investors versus 5 years ago. And these are different conversations both vis-a-vis the macro backdrop, but also the way that investors look at the risk profile of successful Greek businesses and looking for the champions in which they want to invest their hard-earned capital.
Kyle, you mentioned a couple of things that were pretty interesting. First of all, you and the other investors are global investors. Also, your thought process of how to invest in Greece evolved over the years. Can you give us a little bit of your current perspective, like what, in essence, is the driver behind your current thesis about Greece as it relates to government, as it relates to the opportunity set, and get into a little bit more detail. And actually, I'd love to hear the views, because what I mentioned about you stands for the other three investors as well.
Okay. One other thing I left out, I was telling Theo that my wife and I just named our puppy after him. We named our puppy Theo. I thought I'd never met it. Look, as far as the macroeconomy is concerned in Greece, no matter how you look at the indicators, I know for those of you that live in Athens and live across Greece, it doesn't really feel like things are turning yet. But from the macroeconomic perspective, whether you're looking at cement production, new vehicle registrations were, I guess, announced last night, up 16.5% year over year. New tourist arrivals hit an all-time high. And when I was in Greece, I guess in early October, the first direct flight from Beijing landed. And to see the Chinese take over Syntagma Square was an event to be seen. And that was just the beginning. And so I think when you look at basic economic activity, as any macroeconomist looks at, it is starting to turn. It's starting to turn for the first time in 8 years. We've had a 30% real GDP decline, which that is a full Great Depression in any economy when you have a 30% real GDP decline. So from our perspective, it's starting to turn. Clearly, there's a lot of work to do. Clearly, we're not out of the woods yet, but it is the most exciting time to be considering investing in Greece. So from our perspective, that's why we're there. And when we look at the Greek banks, pre-crisis, they had about 60 billion of equity. Today, I think the collective cap of the banks, the big four, is like, $7 billion on an economy. So when you look at Greek bank market cap to GDP, it's the cheapest bank market cap to GDP in the world. So I think it's just a fascinating opportunity. I'm gonna hand it off to John.
Well, I would a few other things. I think the way we think about it is relatively simplistically, I think, which is that if you look at through the first half of 2017, and really for the 2.5 years up until the first half of 2017, you had to read Grexit on the front page of the FT and the Wall Street Journal, 5 times a week. At different times it was 5 times a week, sometimes it was only 5 times a month, but Grexit kept popping up. In June of 2017, with the agreement on the second review of the third memorandum, after that, the idea of Grexit has sort of been taken off the table. So markets don't react immediately, and especially scarred markets like Greece is deeply, deeply scarred. It hasn't reacted very, very quickly to the idea that the political risk is very largely off the table. But we think that obviously there are signs that that is coming true. Like, for example, this bond exchange, everyone talks about the bond exchange. It's a great thing. We agree with that. But Greek government bonds, the 10-year is currently trading at 450. It was trading at 7% coming into this year and was trading at 6% coming into the fourth quarter. It's tightened by 150 basis points in 2 months. You'll not find that in any economy anywhere in the world, almost any time. And what you certainly won't find is an equity market that has not reacted to that really materially in any way whatsoever. So the Greek equity market has not followed bond yields up, yields down and the equity market up. So we would expect that over time that will happen as people start coming out using lower discount rates and models and showing that the future value of present value of future cash flows is much, much higher. The other thing is, Kyle refers to a $60 billion market cap of the Greek banks before the crisis. The Greek banks had a 36 billion euro market cap in 2014. So in the first recovery of the crisis in 2014, they were trading at 6 times where they're trading right now. Now, I'm not making a call that they're going back to where they were in 2014, but that gives you a sense of the possibility of investing in those bank equities.
John, you want to give us your perspective,
Sure,
since you're new in the market as well, relatively?
Absolutely. I agree wholeheartedly with Kyle and John. Kyle, you talk about GDP. We got 3 quarters in a row with positive GDP. John, you're talking about bonds, and definitely when you redo the bond, you need to get more liquidity, and that's why they did that, and it was very successful. And if you look at the returns just this year, like you said, we're talking about over 19% of increase, and in a total rate of return, it's over 23%. It's the #1 performing bond in Europe. So people need to realize that it's real. It's not over, it's not perfect, but there are definitely things that are happening. And a lot of that, let's look at credit rating, 2 upgrades as well. So there are things that are happening, they're all positive. That's one of the reasons we took a dip into the market and look at it, because we do feel this is the time and there's a lot of good things that are happening.
Great. Stephen, you want to?
Yeah, I mean, there's no reason to belabor the point. If it does move up 6 times, I'm going to name my puppy that I don't own yet after you too, so.
Hold you to that.
Good. I'll buy the puppy. No, I think the rating agency moves. I think that the change to foreclosure law, a lot of things that have helped the banks to really provide a pathway to dealing with the 2 things that we're not talking about, one being the NPLs, which I know we'll get into at some point. But with an NPL framework as large as it is, a lot of people want to see that it's a show me state. Show me what you're going to do with that before I'm going to start to give credit for the equity story. And that will come to roost over the course of the next 2 to 3 years in a positive way for the banks, I believe. But the other piece of it, too, that we need to be cognizant of is all of those positives are great. The foreign direct investment component, the exogenous piece, that really needs to continue to push through, so that with some of that off the plate, with that addressed with the 3rd and 4th reviews, I think that they're going to be in a tremendous place come mid-year, hopefully 2018.
Great. Theo, you and Citi and AXIA, I mean, we share a lot as far as visibility on who and what they do in Greece, but I'd love to get your perspective and Citi's perspective on the type of investments and investors that you see right now showing the most interest. Sure. And I think, if you can touch a little bit on what John Wollen said a little bit earlier about the equities lagging. Is there interest for Greek equities, and if not, is there a reason why global investors are not as bullish on equities as they are on GGBs, let's say?
Sure. So that's a fascinating point, how the equity market has not jumped back to reflect what we're seeing in the credit markets. There are some parallels to be drawn with 2014. The reality is that a lot of the market cap of 2014 was effectively state money. It was effectively a much larger chunk of HFSF money. And I think the question is how fast can the private sector catch up with that. Greece has consistently underperformed throughout the crisis in the very crude metric of total market cap to GDP. So whatever you got, the Buffett index or whatever you want to call it, it's performed below its own cycle through levels, as well as below where you see other European markets trading through on a cycle through basis. Now, having said that, in terms of public market opportunities, Greece has always been dominated by the banking sector. This is the predominant component of its market capitalization, and I think it's going to be very much a question of banks driving any potential surge, and it goes back to the very topical points made earlier today on the ability to go about the quality of the balance sheet and the ability to go back to sustainable profitability in the banking sector. Of course, we will always have, being nimble about opportunities and finding, micro businesses where one wants to invest. But if you want to see systematic rise in the stock market, it will need to be driven by the banking sector. In terms of, and I think this kind of, highlights, the demand that we see from a public market perspective, of people looking whether at equity or credit. There are people who are going to follow the market, and there are people who are just going to be opportunistic about smaller opportunities. I believe the more interesting question is, what kind of investors do you see on the private side of the equation? What kind of private equity approach to life do people take around Greece? And again, probably you can actually cluster them in 3 or 4 different categories. You had some of them more brave or luckier, whatever you want to label them, pockets that looked at Greece and actively invested in Greece on the private equity side back in 2012 or 2013. Probably a common denominator between those investors would be that they had a more flexible mandate. They had the ability to react to investment decisions. I always make case in point the constellation of investors who bought the 33% in OPAP, which was a very brave decision. It was a difficult investment decision at the time, both in terms of the macro backdrop, but also in terms of getting conviction. Can I control a listed company with a minority stake? And these were investors who took this conviction and certainly realized extraordinary value. And then obviously as you move across the spectrum of risk and types of investors, you come to today where you have bulge bracket private equity firms, if you want to call them that, whether it's CVC or BC Partners. And there the angle always needs to be business specific, and you need to find a Greek-denominated business where value can be explored because their revenues are very extrovert, they come from outside Greece, or because there is some other alpha generator, whether it's the roll-up of a sector, like what, for example, CVC is trying to do at this stage in terms of the healthcare space. And I think to wrap up this kind of long-winded response, it's fair to say that right now there are very few investors who have not spent time trying to understand Greece. One of the colleagues mentioned it. It's such an extraordinary value opportunity. You will not find people who didn't spend the time to do their homework, but not a lot of them have invested yet. And a lot of the value to be unlocked will come from those people actually getting conviction around value.
Great. And again, borrowing a little bit on what Steve said, but a common denominator with the comments. I mean, we're seeing the de-risking of the sovereign being the major driver behind economic activity and confidence in the market. The banks have committed to a 40% NPE reduction by 2019, and we're beginning to see certain actions. How instrumental do you think is the unlocking of the NPL market, and how would you look to participate in it? Let's start with Steve, and then we'll go down the road.
Yeah, I mean...
Well, directly or indirectly, you're invested in the bank, so...
That's right. I think that no one can give credit to the book value if they don't believe the book value is real. So burn down book value is a simple way to think about a bank. if you're going to have a 25% discount from where it is on a net basis, well, then it should be trading at a discount to that to get you some return. What the banks have been so good about doing over the last several years, and driven really by that stress test a couple of years ago, is funneling so much into reserves right out of the gates. So from an actual provisioning level, you're at 50+%. When you look at it relative to the security that's on the package, if you believe the actual security and stabilization in the end markets, then you're at 100% plus. So there's a real clearing point. And then the question is, who are the people that are most interested? I think the NPL trade over the course of the next probably 2 to 3, 4 quarters is going to start with some of the lower hanging fruit. Unsecured loans charged off are really a pretty interesting, quick opportunity to keep ahead of the Troika guidelines. What that is it's providing people like Interim Justicia and some of the other players that have been so strong, hoist, in the market to be participants. Then it's going to trail into some of the other corporate and SMEs, but you have to kind of think about it on an individual component basis. But I do think that as they stay ahead of the game on these, as they look at securitization or other ways to manage different parts of the book, you're going to see that there's more credence given to those that have servicing capability on the board, as well as the actual clearing price of these, such that you can really start to give value for the book value itself, and then you'll see a re-rating in the stocks.
So the key is optimization of NPLs prior to sales and sell whatever is marketable.
And you have to give some people a little chance to make money along the way too. So having third parties there to participate.
Okay. And John Wollen, you're an investor in banks as well. Can you give us a little bit of your feedback on the same question, and what would you want to see the banks do that maybe they're not doing as aggressively right now?
Sure. Well, so if you look at the Greek banks are very much, it's a large NPE play or NPL play. And whether they're worth where they're trading now, whether they're worth a lot more or less, depends upon almost entirely what comes out of the NPL portfolio. If it goes poorly, things will be bad. If it goes well, things will go very, very, very well. And tied up in that is, of course, the elephant in the room, which is the stress test coming in the first half of this year. So, first half of next year, I should say. And you know, someone told me a couple weeks ago, they said, well, no one's ever made money investing in Greek banks in front of a stress test. If you look back at 2015, clearly that was true. I would argue 2015 was different from many, many, many different perspectives, from political to economic to the actual fundamentals of the banks. But in 2014, it's also true you didn't make money if you invested in the Greek banks in front of the stress test in late 2014, but that's because of the sort of political cataclysms that occurred through 2015, as opposed to anything that happened within the stress test itself. And so, from our perspective, we look at these very large NPL and NPE portfolios, and it's very difficult from the outside to say, okay, well, I know I can stick a pin in it, and I can say I know exactly what these things are worth. But what you can do is you can say, I can probability weight this. I can think a little bit about what happens if we end up that these are either appropriately marked or undermarked, in which case you make a ton of money. And you can see what happens in the alternative scenario. And with banks trading at 0.15 times book, you know how much you can lose. You can lose that much money. And with banks with the pre-provision profitability that these banks have, and with you know, the potential on the upside, obviously from 0.15 times book, we think it's a multiple many, many, many times of that. Also, as I suggested earlier. And so, you know, I think a lot of this is going to come out related to the stress test over the next 6 months. And if there's a relatively benign or a completely benign response to the stress test, then within the next 6 months, these things are going to be trading a lot higher. And so in that instance, you just have to think right now, you know, you have to be involved now or not if you're going to take advantage of that over the next 6 months. So that's the way I would think of that. It's not being able to stick a pin in, okay, they're perfectly appropriately marked, I know that. I think any bank in the world, if you took, you know, JP Morgan and you forced them to liquidate their whole portfolio tomorrow, they would run through all their book value. So if you do that to the Greek banks, they're going to run through all their book value. But if a slower, more measured and intelligent approach is used by the regulators, then you won't. And so that's the way I would think about it.
Kyle, anything to add on NPLs and on your view?
Yeah, I mean, I agree with a lot of what John just said. I think that, one of the other things that we talked about was confidence. The couple of elephants in the room with Greece are, we just went through a couple of exercises. One was with the IMF rattling the cages saying we need another bank recap. I thought that was unfounded, and we can kind of get into our views on that if you want to. I know it's a large panel here, but I think the other elephant in the room is, we really just went through a scenario where the notaries didn't feel like they were protected enough to actually go through with the electronic auctions, which, I'm wondering, are we in a third world country, or are we in a member of the EMU? In the US, if you jump on an administrative law judge's desk or a judge's desk, the bailiff will shoot you. And in Greece, these gangs were coming in and canceling these procedures. So there are kind of a few Keystone Cop things going on in Greece that we still need to get our arms around. And I know Minister Achilleoudis has addressed a lot of those issues, but if they need the help, we can send some teams in to make sure that the notaries are going to be okay to get these things done. And we laugh, but these things are actually going on today in 2017, which is kind of hard to believe. So I think for us, the global investment community, to really get confidence and get confidence moving forward, we need some of these kind of basic things to get taken care of. And I know it's not as easy as we say it is, and there's a lot of, let's say some of the customs that are kind of deeply embedded in the Greek culture have to change. And the good news is meeting with the various bank CEOs, CFOs, and the government, it seems to me like people are willing to put the effort in to change those things. And so I think there are obviously reasons why things are priced where they are, as John was just saying. And I think that all of these confluence factors get us to where we are today. But I think that there's enough effort being put into some of these projects to move these things forward.
So you stuck to the beautiful macro thesis, and it was very powerful. But you do see the little nitty-gritty details, and you're still there, which is very inspiring, Kyle. But John Koudounis, you're involved in quite a significant transaction with Ethniki Asfalistiki. We wanted to understand a little bit the logic behind that transaction, what motivates you, and are there nuances there that you're dealing with, or things that you didn't expect when it comes down to Greek reality?
Look, every large transaction, is largely complex. So there are complexities. It is Greece as well. But for the most part, why did we invest in this transaction? When we're global investors, and when we look at things, we looked at the asset, and the asset was actually very, very good performing. We thought there were some low-hanging fruits that we could actually change and make it even a better performing. And it was during a time where the environment, the underlying sovereign, was in a crisis, is in a crisis, even though we feel strongly that we're starting to come out. So when you look at an asset that's performing well and that you feel that you can improve it immensely, in a really difficult environment, the upside we felt and we still feel is extremely high, and the delta is really, really strong there. So we feel when the economy turns around, the asset will, do extremely well. It's doing well now. So that's what we looked at. We looked at the actual asset first, then we looked at the country, and the upside on both were tremendous. That's why we went in.
Great. And as a closing, and then we'll open it up for some questions. How do you see Greece adapting to a new reality? What's your vision of the country? Let's start with 2018, and let's say 3 or 5 years out. What do you see, especially with some investors that are basically in larger, more illiquid type of investments that we know that we're going to see them around a few years from now, unless there's a quick exit. But so maybe we start with Steve, and we go down the line as far as 2018. What is the
Yeah, I mean, our view is we feel very good about what the next year or two look like. I mean, you've got the global upheaval around tourism, things that are happening in Egypt, things that happen even in Turkey. which really provide an opportunity, and which is why you've seen 9 to 10% year-over-year growth in tourism, which, as tourist assets have been a real attractive area for growth, you've been able to see more trades in that space on even the NPL front. I do think that they're going to have a tremendous opportunity to grow when you think about what GDP can be for next year. I think one important thing to think about, you have 34 months of consumer confidence increases at such a good rate now, but imports were 9% this last year, and that is going to hurt GDP. So getting back into some component of an export-driven economy is going to be a key fundamental for those 3 to 5 year run. And actually doing a lot on the FDI side I think is going to be important. So you have a good 2-year trajectory. I think you have an even shorter term whip from an improved and a beneficial view of the stress test that comes out, John. But after that, it's going to be the real blocking and tackling to say, what are we now doing from an investment side? How are we doing what we need to do from a tax side so that there is more interest in people coming in and really driving foreign investment. So I'm sanguine, I'm very optimistic, especially on the near term, but when some of those real opportunities around tourism start to wane because hopefully the global economy or the global tourism market finds a way to stabilize, I want to see that Greece is still in that great position. And as an investor in one of the systemic banks, we always say banking is a warrant on the economy. So really are very optimistic about where our position and our investment stands relative to that macro overlay.
Well, one of the biggest things that Greece has going for it is tourism. And like you said, this year we had 30 million people visit Greece. It's a record. We expect more next year, especially with what's going on geopolitically with our neighbors. So that's a fantastic thing. And it's only going to get better. And so the country can continue to build on that. We still need more hotels. They still need the infrastructure to accommodate all these tourists. And like you said, Kyle, now the Chinese are making it more of a tourist attraction as well. So that's going to bring in a lot more people. So that's a great thing for the country. Also, despite who, the political party in office, they've been in office for what's been a longer period of time than other parties in the last few years. So that brings a certain source of stability to the country as well. So that combination, I think, is also positive going forward.
Great. John Wollen, your outlook for 18 and beyond?
Well, I think this is one of the reasons why this conference and other conferences like this are so important for Greece because, I think someone mentioned earlier today the drawdown in the Greek economy from pre-crisis to now is largely a starvation of investment. There are other consumptions much lower, obviously, but you look at the difference between 240 or whatever billion euros of GDP and 175. More than half of that is reduced investment. And I'm not arguing that there is a chance that Greece goes back to 2007 levels of investment. I don't think really anywhere in the world is going to do that, and it's a good thing that we don't, given what happened immediately thereafter. But Greece is underinvested and is starved for investment, and so I think the one key missing piece to the puzzle right now for Greece to recover is substantially increased investment, and it's across the board. It's in everything. It's obviously in sectors like tourism and energy, but it's really in manufacturing. But it's really straight across the board, and so what I would argue is that if Greece is able to prove the stability, from whichever political perspective it comes from, if it's able to prove the stability and the attractiveness of the investment opportunity and the idea that things aren't going to change every 1 year, 2 years, 3 years, the rules aren't going to change, then you're going to see substantially dramatic investment in Greece, and that will allow the Greek government, which is running, sort of unprecedented primary surpluses, which will then be higher, to reduce taxes, which will, in fact, increase investment and growth opportunities again. So I'm very, very optimistic if the positive scenario turns out, and I'm optimistic that it will turn out. So sticking a pin in a number, 1.3, 1.7, 2.1, I think all those things are sort of like, who cares? The answer is that if Greece is able to do this going forward in 2019 and beyond, the numbers will be much, much higher for a short period of time than people in this room can imagine or fathom. That's our view.
That's a tough act to follow, John.
Saying what happens if it doesn't.
Yeah, well, look, I will take a little bit of the other side of let's just say what we worry about. I agree with literally agree with everything John just said. I think that we think that that the Greek economy is on the proper trajectory. We think that once we get through IFRS 9 and we get through the stress test, we get through the banks moving NPLs, NPEs off the balance sheets, that the economy is going to be unlocked and move higher. What we focus on, geopolitical risk is the real risk. You know, we have another Catalonian kind of referendum December 21st, and our view is that Rajoy is going to actually lose this one. And does that mean that there's going to be a secession? We don't think so. We think they'll come up with some sort of bargain, but that will provide some problems for global investment for a few weeks. You have the Italian elections next year. You have the large guy in North Korea that likes to shoot missiles. You have the U.S., you know, building up arsenals in Guam. You have all these things going on that you need to be thinking about or temper our enthusiasm for Greece with all of these crazy things going on. So as far as what could go wrong in Greece, I think Greece is on the right trajectory. I think it's what could go wrong with all of its neighbors is another story. So you need to pay a lot of attention there. So I'll leave it there.
Yeah.
So I mean, a lot of very intelligent things can be spoken. So maybe I take the question of how does Greece look like 5 years down the line or beyond, and I'm pretty confident that, you know, in the medium run, Greece will still be what it was 10, 20, and 30 years ago, which was fundamentally a country of 11 million, of people who are very vibrant, very outgoing, very extrovert, of people who like to spend, and, you know, with certain, you know, very, very specific, you know, cultural features, like, you know, you want to be a homeowner but not be over-levered. These are the fundamentals of the Greek economy, and it's a place that people want to visit and want to spend their money and actually want to live in Greece rather than migrate out of Greece. So that's my conviction for the future, and synonymous to a very prosperous economic activity. I would argue just two more things. One is, couldn't agree more with Kyle. There is a risk around geopolitics. There is a risk in the sense that, you know, within everything that we're experiencing, this is probably the longest period of geopolitical tranquility around Greece. We've never had an uninterrupted 30, 35, 40 years of geopolitical tranquility. So, you know, this commands us to be even more vigilant and to actually read through, you know, what are the underlying risk and dynamics. And the second point is, again, picking up on something Kyle said, but taking the variant view, and hopefully I'm not going to upset you to rename your puppy or anything, but I think that Greece hasn't done a great job in terms of marketing how receptive the people of Greece have been to change. There is a continuing perception that you know, systemically Greece does not accept change. You've got broken institutions, you've got broken structures. Yeah, you're starting off a very, very low base, you know, which is that, you know, you had a bankrupt infrastructure as a society. But reality is that the depth of the reforms that we've seen in Greece, were they to have happened in any other place of Western Europe, the reaction would have been radically different. I cannot imagine whether it's capital controls or the super deep cuts that we saw in the public sector taking place in places like France or even the UK, and the general public actually being so receptive and acceptable to them.
Thank you. And just to kind of add a little bit on what Theo said, because it's very crucial. I mean, you know, we have these investors in front of us who 5 or 7 years ago, I couldn't even imagine, you know, Greece getting such attention. Where is this driving? This change and the adaptation of the Greek business people to, you know, capital such as this. It means that they accept corporate governance, they accept dilution, and they take in capital that demands and requires, you know, business plan rigidity and, again, a long-term vision that the Greeks lacked in the past. So these competitive capital, instead of going anywhere else in the world, if it's diverted towards Greece, it's because it's diverted in places and investments that are willing to accept all of what I just said. So I think it's fantastic to hear where we stand today, where every single year that we come to Capital Link, there's positives and negatives. This year, there's definitely a lot more constructive sense with all the investors, and I'm very happy to hear that. But I think 10 years out, we see a completely changing landscape where Greek corporates will be funded by institutional capital that require a lot of things that were not required in the past from Greek businesses. And we see money being diverted in projects that are instrumental for a very fundamental change and shift in the Greek economy, such as Elliniko, and a lot of other projects that are not only in tourism and so high profile, but in every other aspect of the Greek economy. So with that, I'm going to open it up for questions. In the back, there's...
Hello, panelists. The question goes for all the panelists. Nikos Hadjios from Merit International. I have a question that has two parts. Mr. Koudounis, rightfully so, said that Greece is lacking investments in hotels and tourism. So the first part of my question to all the panelists is, would your companies be interested in actually investing in hotel investments in Greece? And the second would be, what kind of deals would be appealing for your companies? Thank you.
Take it on.
What was the last one? The second part of that question, maybe one of the other panelists heard. What was the? Would you be in?
For your companies?
In tourism.
Less of a tourist investor, but well, I'll say from our standpoint, we don't do much in the hotel and tourism space at WL Ross. We have been very much focused on identifying interesting corporate opportunities that have an export bent as well. So we've looked at a few assets that have been, unfortunately, taken over by the banks, independent of what's going on with Eurobank, but also really a place where there's that dynamic shift and kind of an opportunity away from the tourism sector. So I probably wouldn't be as helpful to you from that standpoint.
I think there is a lot of movement. I think there is a lot of interest in hotels. I think there's been a couple of iconic hotels that have been sold in Greece just recently. That of Aster, that of the Hilton. And I think that there are investors. I know that I have spoken with the CEO of Hyatt very recently, and they are looking at in Greece as well, because they do not have, I think they have one up in Thessaloniki. So I know that there is interest, and I think that there's going to be continued interest, and I think it grows on each other. The more people see investment and foreign investment, the more the people are going to continue to invest, and I think we'll continue to see that.
I view tourism in Greece from a tourist perspective, actually. We're not involved in the...
As far as John is concerned, he invests in public markets, and it's unfortunate that there's not a single investable company that represents hotels that he can actually put a few million in. But hopefully that will change.
You know, one thing Greece does best is tourism, and I think that if the current government would engage in changing the land use permits around the Athenian coast, you know, I don't think it should look like the Spanish coast, but it could easily look like southern Italy or even Croatia, for those of you that have been there. I know the Four Seasons is building there, but they should be calling the Amman and St. Regis and all of these places and be thoughtfully building the Greek coastline. I think would be a fantastic thing with various concentric circles of GDP growth around them, kind of levering what Greece does best. Like, that's my own 2 cents, and I'm not any of those hotels, but that's what I'd be doing.
Yeah, I would just add to that, you know, one thing that the Greece hospitality sector is probably missing is capacity and scale. So we have a lot of fantastic assets, but they're very fragmented, and probably what you need is a few more platforms which actually deliver scale to the feeders of traffic. Because right now it is a market that has a very much a price-taking idiosyncrasy.
One more question here.
So thank you for your analysis. As a Greek, this is, you know, I'm delighted to hear something positive in quite a while. So my question is, more about, substantiate your confidence about your analysis. So what has happened, if you can give us specific examples of what has happened the past few years, couple of years, that make this upward trend sustainable rather than individual upticks in a system that's fluctuating in crisis and due to extraneous factors.
Kyle, I think that was directed towards you.
I'll take it. Hey, look, when you look at, again, back to this issue of peak GDP declines, you had a real GDP decline of 30%. When you study history of the world, you don't see developed economies that have 30% real GDP declines over a decade. And so, we have this term in our office, you can't break your arm jumping out of the basement window. At some point in time, there's a margin of safety that's there that's enough for you to start looking. And when the globe's growing at, call it 2 or 3% real, and Greece is actually, in my opinion, the head of the snake of the One Belt, One Road project for China. It's the largest deep water port between Asia and Europe. Like, strategically, tactically, it's one of the most interesting places in the world that's just really found a way to screw everything up. And now I think there's been a lot of intellect kind of poured into Greece that have turned it around. And again, you look at these macro indicators, and every single macro indicator we can find is starting to tick higher. So if you ask whether it's sustainable, what I'll tell you is unsustainable is 30% decline. It's not going to decline another 10% of GDP. I'm fairly certain of that, absent kind of a catastrophic geopolitical event on its own. So I think it's the nature and the severity of the decline, coupled with kind of the duration of the decline, that lead us to believe it's the right time.
If I may add just one thing very quickly, and I agree with everything that Kyle said, but the other thing is that Greece engaged in a 7 or 8 year recession and depression, obviously, but also a 7 or 8 year debate in terms of what it wanted to be. And even, like I said, into the earlier part of this year, so much of the focus was on the political. And so much of the focus over the last 3 years clearly has been on the political, but for the 4 or 5 years before that as well. And I think so much more focus now in the markets will be on the fundamental, but that feeds through into economies as well. When people are always looking at, is there going to be a Grexit or not, that's a really, really negative basis upon which to have a growing economy. People don't invest, people don't engage in economic activity. And when you take that sort of political risk off the table, and then you're just sort of debating how we're going to stay in the Eurozone, how we're going to, construct our political economy, it's a very, very, very different ball of wax. And so I'd argue that off this baseline, there will be more investment. The only question is how much more.